Second quarter US banks earnings season is in full swing. JP Morgan results topped estimates, sending shares higher by nearly 2% in the session. Joining me now to discuss the performance of the sector so far is Dick Bove, Chief Strategist at Hilton Capital Management, who joins us down the line from Florida. Dick, thanks so much for joining us. So far we've heard from JP Morgan, Citi, Wells Fargo and Bank of America. What have you made of the performance so far?
Actually, it's pretty good. I mean, JP Morgan's numbers was actually superb. They were really good. Bank of America, I think, also came in with very strong results. When we start to get away from the two of them, though, it's not quite as good. I mean, Citigroup was mediocre, but more on the plus than the minus side, and Wells Fargo was very disappointing. So, I mean, there has been very different results when you take a look at each one of these banks. And I think the difference, really comes down to the consumer or the American household. I think that you will notice that JP Morgan and Bank of America have really oriented what they do toward, American households, hopefully at the upper end of this income scale. Citigroup has kind of pulled away from that market, and of course Wells Fargo has some difficulty with the consumer at the present time.
So you mentioned how strong JP Morgan was there. Is there anything that could derail this success in the coming months?
Well, yeah, I think that there's no question about the fact that banks only can do as well as the economy that they serve. So if you have difficulty with the U.S. economy, in other words, if we were to get into a recession, which I guess some economists are now projecting, if that were to happen, then all bets are off because loan losses would go up substantially. The ability to sell product would come down substantially, and the banks would get set back meaningfully. I happen to be on the side of those who believe that the economy probably will continue to grow. This will be a big quarter, right? But the economy will continue to grow somewhere in that 2.5% to 2.75%, range. And if that's the case, banks should be okay.
Let's talk about Citigroup for a second, because we saw the shares close down by 2.25% on Friday. They missed on the top line despite a profit beat, and year to date the shares are down around 10%. So why isn't the company delivering, and are you optimistic in the longer term?
No, I actually don't like that stock at all right? And I don't like the company's strategy, and I think that they're doing things that are very harmful to the business over the longer term. I think it starts with capital. I mean, they promised to pay out something like $60 billion, $20 billion last year, $20 billion this year, $20 billion next year, in terms of, getting people enthused about buying their stock. And it doesn't work because that $60 billion in common equity is getting a return right now. And if you give it away, you're going to lose earnings from giving it away. You have reduced your secular growth rate, and you have leveraged the business, which is unnecessary. So I think that the core strategy is a bad one, excuse me, and I think that the fact that they're pulling out of so many places around the world, the fact that they're pulling back from the consumer, I think they're making a lot of mistakes at this point, and I really think it's a stock that should be avoided.
I want to get your take as well on Bank of America, because we saw revenue beat forecasts, and trading and the loan growth both appear to be performing well. And there was an upbeat comment in the earnings call this morning from CEO Brian Moynihan saying the balance sheet is very strong. So are you more positive on this stock?
Yeah, it's my favorite stock. Okay, so I think that the reasons that Bank of America is so attractive is because they have, $1.2 trillion in deposits. And if you think of a bank as a manufacturing company, and I'll compare it to an oil company, if you have that much in deposits, it's like having a huge oil find, because you're going to deploy those deposits into the creation of loans and investments. Now, Bank of America was not doing that in a long period from, we'll say, 2006 to about 2016, because they had made these terrible acquisitions. They were dealing with all sorts of legal, governmental, loan, etc. problems. But Brian Moynihan has proven to be an expert CEO. He was able to quell, if you will, all of the problems after a long period of attempting to do so. So now Bank of America is in a position where it can use its excess liquidity, it can use the deposits that it has to build growth in the company, and that's exactly what they're doing. I think ultimately it's a $60 stock. Now, it may take a couple to 3 years to get there, but I think it's more than a double from the current level.
Now, taking a step back, we know that the market more broadly is very concerned about these growing trade tensions between the US and China. Do you think that the banks are worried about what it could mean for clients and their risk appetite?
Well, I think actually it's limited to a very small number of banks. In other words, when people look at the US banking industry, they perceive it to be consisting of 6 companies, right? It's you know, the ones we've talked about, plus Goldman and Morgan Stanley. So the net effect is those companies do have international relationships. Wells Fargo really doesn't, but the other 5 do, and therefore, in some fashion, they do get impacted by the problems with trade. The one that's most impacted is Citigroup, because at one point, Citigroup claimed itself to be the largest trade finance company in the world, topping the French banks, which had been in that position. So, I mean, basically, those companies presumably are going to see some difficulty with that portion of their business, but they're so huge, you know, that it's not going to be offsetting for their overall business. And for the other 99.99% of the banks in the United States, they're purely domestic businesses. They don't do anything overseas, and therefore they're not going to be impacted unless the trade wars lead to a recession, and I'm not sure that they will. I actually think that the United States is going to win this trade war because China can't afford not to level the playing field, we'll say.
Now, there's no shortage of tailwinds for the banks at the moment, whether we're talking about rising rates from the Fed, deregulation, tax cuts. So why haven't the bank stocks been outperforming this year?
Well, let's go back to that issue of capital, all right? If a bank, you know, says to you, I'm going to give you my capital because I don't have any place to put it, what is the bank telling you? It's telling you that the business is not as good as it should be, because if it was, they'd be using that capital. And it's telling you that they're really harming the future growth rate of the bank because they're giving you the capital that they need to grow the business. Remember, banks are capital-intensive industry. You need capital to make loans, and loans are what the banks sell. So if you continue this obscene, if you will, giving of capital away to stockholders who don't want to have anything to do with your company because, you know, they're selling you their stock, they're sending a terrible message. And so I think that what investors are looking at is, number one, the fact that they are not growing their capital. Number two, investors are beginning to realize that as interest rates go up, deposits are going to leave the banking industry. And again, that's their oil, that's their raw material. And number three, you know, there are questions about why they can't grow their loans as fast as the smaller banks, because smaller banks in the United States have been growing their loan portfolios at 4 times faster than the big banks. So I think there's a whole series of questions concerning the business models of these companies, which is leading to the poorer than expected stock performance. However, I think the stocks have simply gotten too cheap. You know, the gap between the value of the biggest banks in this country and the mid-sized banks in this country is so significant that I think it's going to contract. And I don't think it's going to contract because the small banks are going to go down in price. I think it's going to contract because the big banks start to get a better valuation.
Dick, thanks so much for your time.
Thank you very much.
That was Dick Bove, Chief Strategist at Hilton Capital Management. Thanks so much for watching IGTV. I'm Victoria Scholar, and we'll see you very soon.
Subscribe to IG for educational content, company insight, financial analysis, and expert commentary.